What's up, traders? Welcome back to the Statistical Trader YouTube channel. I'm Diamond, in case you still don't know me, and today we're going to be talking about the edge. You must have an edge in the market. Use this thing to get more edge. This signal gives you the edge. Blah blah edge blah. We all heard it. We all kind of have an idea of what it is, and we all want it, that's for sure. Okay, well, but what is this magical edge? Well, basically, it's just a fancy way of saying a statistical advantage. When you win 51% of the time, it's that 1% over the 50 that is your edge. And when you do the same thing for long enough, the edge is what actually makes you money. A casino always has the edge over the gamblers, and like so, you want to get this edge over the markets when you trade. Well, to get that statistical advantage when investing, you can do whatever. Analyze the company's financials, use a fancy new strategy from the internets, or anything else you feel works. But the question I have is, how do you actually know when you have the edge? Does trading moving average crossovers give you the edge? How about trading based on a lucky card draw? Well, lucky for you, this is where we find out. And of course, this channel wouldn't be called Statistical Trader if we didn't use math and statistics to do it. So before we get down to business, let's think a bit of how we should actually approach this, let's call the edge evaluation process. Now, if you have a trading track record, you can simply go over your past trades and see if they are making money in more cases than they are losing money. And it doesn't really matter if you do 10 losing trades and 1 profitable, or 2 winners and 1 loser. As long as you do it consistently and making money, you are good. So by looking at your past performance, you can kind of see if your trading has edge. Now, a very interesting concept is that actually for some reason, we always try to measure if our entry signals have edge. But if you think about it, your trade is only as good as your entry and exit signals combined. You may have a killer entry signal, but if you exit your trade late, you might not take advantage of that killer signal at all. So here's the interesting part. We can never evaluate the edge based just off an entry signal alone. A trade is 2 parts, and we need to evaluate them together. And I have the formula to do just that. And what's great, this formula even works if you don't have an exit signal. The beauty of this formula is that it actually tells you how your edge evolves over time after entering the trade. So for example, you may find that your entry signal has killer edge for the first few days of the trade, but then after that it just turns south. Or you may find that your signal has great edge over the long period of time, but the first few days or weeks in the trade might be rather crappy. So let's look at what I'm talking about here and get into the formula of how you can calculate this yourself. Now, real quick before we get to the math, I just want to show you how the end result we are trying to achieve looks like. Now here you can see a chart of the edge evolvement over time being in a trade for a strategy that I have just backtested. This chart shows what is the expected edge of this strategy and this portfolio for each bar we are in a trade. Now you can see here that on average it is expected that your trade on the first bar in the trade will have the edge ratio of 1.21. The second bar in the trade is going to go down to 1.07, and it starts picking back up from there. So 1.21 for the third bar, the fourth is 1.41, and so on and so forth, and it just keeps on rising. Now you will understand this better once I finish explaining it by the end of the video, but here at the bottom I have how many trades actually go into the calculation of this value of the edge. So basically how many trades we had spanned through that number of bars in a trade. And here at the top I have an average trade length of 17 bars. This is a strategy that has a lot of trades, and this basically means that on average, after the signal is taken, a trade lasts for 17 bars. And we can expand it, as you can see, but the likelihood of these actually playing out as they are showed here on the chart go less and less the further we go back in time, just because it has less statistical merit, because we have less trades to actually evaluate that value. So I just take what's above the average of the trade length and I just take those values because that's just more trustworthy statistically speaking. Now, a value of more than 1 means that your trade is likely to move in a favorable direction for that bar in the trade. And the value of less than 1 basically means that your trade is more likely to move against you for that bar. Now I hear you, but Diamond, you have this fancy software painting all these charts for you, but what about us? Now worry not, I will be doing the calculations for this in an Excel spreadsheet, and I will be sharing that spreadsheet in the description below this video. More so, I'm actually working really hard to make the software available to the public, So if you are interested in any way, make sure to subscribe to this channel because I will be posting updates here first and foremost. All right, now let's get to the math. So as usual, you will need a list of past or hypothetical trades that you want to evaluate. Now, first of all, we will be calculating the excursions of these trades for each bar in the trade. Now, an excursion is basically just a movement from the entry price to one or the other direction. So we will be calculating the maximum favorable excursions or movements that go in the profitable direction and maximum adverse excursions, or in other words, the movements that go in the losing direction for each bar that we are in the trade since the entry point. So how do you do that? I have ran a backtest here, so I have a list of sample trades. So let's take a few of them and manually calculate the MFE and MAE values. As I said, I'll be using a spreadsheet to do that, and I will share that spreadsheet with you in the description of the video. Okay, so we have a trade here. So first thing we need to do is actually note down the entry price of the trade. So this trade was entered at the opening of this bar, which means that the entry price was 9.61. Next, what we need to do is actually get the highs and the lows of each bar in the trade. So the first bar high is 9.83 and low is 9.61. Okay, bar number 2, high 9.93 and low 9.71. So do that for the rest of the bars. Okay, so for the last bar in the trade, we also need to add the exit price for the trade in the spreadsheet as well, because for the last bar, the maximum favorable or adverse excursion cannot be lower or higher than the actual close price of the trade, because once we close the trade, wherever the bar moves, that really doesn't matter to us. All right, so we have the list of data that we need. Now we have to get to the actual formulas. This trade is a long trade. So for a long trade, the favorable excursion formula goes as follows. We subtract the entry price from the high price, and if the ending value is more than 0, we use that ending value. If it is less than 0, we simply use 0. So for a short trade, everything's actually going to be in reverse. So our favorable move is actually a move down. That's why we will be subtracting the low value from the entry price for the shorts. And if it's less than 0, we use 0. If it's more than 0, we use the result. Okay, so let me jolt down the formula real quick. So there we go. We have the maximum favorable excursions calculated. Now, an adverse excursion means that we have to move down from the entry price. So for a long signal, we will be subtracting the entry price from the low value of the bar. If it is more than 0, we use 0. If it's less than 0, because an adverse move is always going to be negative. If it's less than 0, we use the value. Now, to calculate the edge of your strategy, we actually need more than just a single trade to do so. And if you trade a portfolio of instruments, you will have different price values, different excursion values for each instrument based on the price of that instrument. So if you are trading a stock that's worth $100, a favorable excursion for a single bar might be a few dollars, while if you are trading a stock that is worth, let's say, $10, the favorable excursion per one bar is most likely going to be anywhere between like 5 and 20 cents. So we need to actually normalize everything. And the way we normalize things here is by using the average true range. So to do that, I personally use the ATR value of 14 periods that was on the entry bar of this trade. So let's go ahead and find the ATR 14 for the entry bar, and let's add that into our spreadsheet. And now we can actually calculate the normalized adverse and favorable excursions for this trade. So we normalize things by dividing the excursion by the average true range value. All right, now let's do the same thing for a few more trades just so that we have some more information to work with, and then we can go ahead and calculate the actual edge of this strategy and see what it looks like. Now, to normalize the excursions, you can use whatever period of average true range you like, or you can actually normalize it just by the entry price of the trade itself and have the percentage value of the excursion instead of the actual monetary value of it. I like to use ATR 14 because it's been statistically proven to work well, as well as it actually eliminates the factor of volatility. So now we take the normalized excursions that we have, we stack them side by side for each trade, and we calculate the averages for each bar. Now naturally you will have some trades that you were in longer than the others. And that's okay, just keep in mind that the actual statistical relevance of the edge value that has less trades in the calculation is going to be lesser than the edge value that has more trades in the calculation. So now that we have all the averages calculated, we can actually finally go and calculate the edge values for each bar in the trade that we are for this whole strategy. And you do that by simply dividing the average MFE value by negative MAE value, and there you have it, you have the edge for the bar. Now after doing so, you will have a value per each bar in trade, anywhere from 0 to whatever. Now what this value means is actually how many times your favorable move is higher than your adverse move per bar. So if your value is more than 1, it means that your trade is most likely going to move further in the favorable direction than it's going to move in the adverse direction, and vice versa. If your value is less than 1, that means that your trade is going to move in the adverse direction further than it's going to move in the favorable direction for that bar in the trade. Now one more thing, do you remember I said you can even calculate this if you don't have the exit signal? So what you do here is you actually calculate the MFE and MAE values for as many bars you like after entering the trade, and that's it. This might even be a great indicator of when to exit the trades based on time to make the most money. You may plot these values on your spreadsheet and you might actually find that your edge, let's say, goes up until day 5 and then crashes down after that. So you know that day 5 is a very good day to actually exit the trade if nothing happens, if your stops or targets don't get hit before then. And this is just one simple example amongst many of how you can use this value to actually improve your trading strategy. If you find any other great use cases for this edge value, don't hesitate, share it in the comments below with other traders. So there you have it, a statistical evaluation of how much edge your signals actually have. I hope you find a good way to use this to make your trading better. As always, if you want to join the community of traders that trade using science, make sure to subscribe to the channel. Thank you so much for watching, and I hope to see you in the next video. Bye!